Today, we are recording the fourth episode of the Baird Retirement Management Show. We are joined again by Greg Ashcroft from the Ashcroft Pesek Bartosh Group. Greg is a Chartered Financial Analyst, a Certified Financial Planner, and is a Senior Vice President with the Ashcroft Pesek Bartosh Group. Greg has worked in the industry for 9 years. Today, Greg will be talking about volatility, dollar cost averaging, and the misperceptions that investors have regarding those two topics.
The topic that I want to cover mostly is demystifying volatility, demystifying dollar cost averaging, and really trying to discover within those two terms what kind of investor benefits from ongoing volatility, what kind of investor is best served by dollar cost averaging, and then where in an investing career you would not be served with volatility and where dollar cost averaging kind of loses its luster. So the example I'm going to provide, and I will include the series of returns in the show notes, we're going to take a look at and take kind of a deep dive on the lost decade. So the lost decade in the investment management world begins January 1 of the year 2000, and it ends December 31 of the year 2009. So that's a 10-year period, and we're really just going to be examining the S&P 500 with dividends reinvested. So S&P 500, the reason we're using that is it's probably the most common growth-oriented vehicle that investors own. It's an index. It's not actually the 500 largest companies in the United States. It's just a group of companies that the Standard & Poor's thinks is representative of the United States economy. However, again, like I said, very common growth vehicle. Between January 1 of 2000 and December 31st, 2009, if you looked at the series of returns like I'm looking at them now, nothing would really jump out at you as being extraordinary or even highly unusual, except for maybe what happened in 2008. 2008 was the height of the financial crisis. The S&P 500 returned about a minus 37% that year. But other than that, the series of returns isn't going to jump out at you as unusual. However, if you run the math on this and you compound from January 1 to December 31, you come out with about a minus 0.1% per year return for a lump sum investor. And by lump sum investor, I just mean by what I mean by that is a person who put $1 million into the S&P on January 1st of 2000. You would have compounded your money at about minus 0.1% per year for a decade. So you would have lost money in the S&P 500 over the course of that 10-year period, which for some people, they can sustain that. That's not that big a deal, particularly if you're young. And we're going to kind of get into why that's not necessarily a horrible thing if you have a longer time horizon. But for a person who might have needed to invest a portion of their money in equities and then turn that money into cash after a decade, it wouldn't be unusual for them to have expected to maybe double their money over that period. And in this case, they actually lost money. So let's get into now kind of where the discussion is going to go with regards to dollar cost averaging. So if we look at that and we say, okay, I invested $1 million into the S&P January 1 of 2000, I bought and just held, and at the end of that 10-year period, I'd lost about 0.1% per year. What if instead of doing that, I had bought in 10 equal installments at the beginning of every single year $100,000 worth of the S&P 500? Now, the calculations that I've run here, they might not be as precise as some of the ones that other people have run, but this is going to get you pretty close. So if you'd been a dollar cost averaging investor putting $100,000 a year into the market every year for 10 years, your results would have been much better. So rather than losing 0.1% per year, you would have gained about 0.5% per year on your investment. So your final dollar value investment would have been about 1.05 million, maybe 1.051 million, something like that. Nothing to get extremely excited about over a 10-year period owning a very aggressive asset, but certainly better than ending up with less money. The point I want to make there is you were, in this case, a net buyer of the S&P 500 over that 10-year period, which just means you put more money into the market over that period than you started with in that investment. Okay, so rather than being a person who had a lump sum investment, you've got the majority of your capital already tied into the S&P, fully exposed to that volatility. You're only exposing $100,000 at a time. So your real exposure, in this case, it was unfortunate because a return was pretty negative right there at the end when you had a lot more exposure. But because you missed out on some of the earlier bad returns with only putting in $100,000 in at a time, you still did better than an investor who had put their full $1 million in January 1. That invites in this question of the order of returns. So we know because compounding your money is just multiplicative. And that means no matter what order you multiply numbers in, the end product is always the same. You can try it yourself. Put a series of numbers down, multiply them out, you're always going to get the same result. What that means for the lump sum investor is that they can be indifferent to the order in which they receive their returns because it does not matter. The ending valuation does not change if you did not add money to or pull money from your investment. Whatever the series of returns comes out to be, that is what's going to dictate your ending dollar value. It's going to track with that annual rate of return dollar for dollar. I've just shown you that for the dollar cost averager or for a person who's putting money into the market, that's not true. We took a minus 1% per year return and we turned that into about a positive 0.5% per year return. And the S&P during that time, I have to make this clear, did the same. The only thing that changed in this case was the dollar values did not track the returns of the S&P because we were exposing more and more and more of our capital to the returns of the S&P over time. Okay? So for the dollar cost averager investor, the next question would be, if we could manipulate the returns, how would we want to experience those returns to get the most out of our money? What if we set up that series of returns and we got all of the really good returns on the front end? So we got all of the positive years during that 10-year period on the front end. What would have happened? How much better or how much worse would the results have been? And we know, because you can do this yourself, the results were much worse. If you got all of the positive returns at the beginning of that 10-year period and then you stacked all the negative returns at the end, you ended up with about $500,000. So you lost close to 6% per year by doing that dollar cost averaging strategy. And again, let me make this clear. Same amount of money is going into the market every year, $100,000 a year for 10 years. You got the same returns over time. So if you multiplied that out, you would still get whatever the returns were of the S&P 500 over that decade, about minus 0.1% per year. But because you were exposing your money to the market and you got all of the good returns early, by the time you had your full investment in, you got all of the bad returns late. So more of your money was exposed to the bad returns than in the previous example. So that was the worst possible outcome for the dollar cost averaging investor. And that also shows that dollar cost averaging is not the end-all be-all of investing. It is not a fix-all approach. You can still get fairly negative results. You can actually do worse than a lump sum investor as a dollar cost averager if the sequence of returns is wrong. However, if we got all of the really negative returns early, so what if instead we flipped this on its head and we thought, all right, we know that we got a bad outcome by getting all of the good returns early, but what if instead we had front-loaded the misery and we had taken it on the nose for a few years, but then things started to look up? Ending valuation on your investment was about $1.7 million. So you compounded your money at about 5.4% per year just by changing the order of the returns. You might be asking yourself, why, oh why, does any of this matter? And the reason that this matters is for most investors, you're going to be investing from very early in your career, where you're probably going to be dollar cost averaging, all the way up until the point that you retire. And then at the point that you retire, you're very likely to stop putting money in the market and actually start taking distributions from your assets. And when that happens, the nature of returns changes fairly dramatically. So you can imagine as a young person, if a genie came to you and said, what would you like to have happen in the market? Your response should be, and this would be subject to saying, hey, we know equities, historically they've done between 7 and 10% over time. If the genie told you over the course of your career, you're going to get a 10% annualized rate of return, how would you like to experience those? As a dollar cost averaging investor, the order matters a lot. And knowing what we know now about how you would want to front load the misery, you would go, okay, Genie, I want you to reserve all of the return for that annualized 10% for the very last second. And I'm going to put all of my money into the market right before we get that dramatic upturn. Because you can imagine if you had a series of years while you were working where you're putting money into the market where you're getting negative results. So much like the last decade, S&P 500 is in a decline over the course of your career. If stock prices are really low while you are a net buyer, you are in a position to benefit a lot from that order of returns, right? So you're going along, you're buying. The genie grants your wish. Finally, at the 11th hour, we get a dramatic up year, and you experience wonderful returns on your money. That would be the way that you would maximize it. If you were a lump sum investor, you could be indifferent. You would say, well, I don't really care how I get the returns because I'm not really adding to my investments and I'm not pulling from them over time. So I'm going to get that 10% per year no matter what happens between now and the end of my career. If, however, you are a retiree and the genie says, well, you actually need to pull some money out of your investments, what would be the best thing that you could get or the best order of returns that you could get? We would have to flip this math on its head. Because as a retiree, when you are compounding down years with distributions, you want to get those as late in the cycle as possible. And that's because as you are winding down your assets, you're going to have, fewer and fewer years from which you're going to need to draw, which means that the burden on your portfolio is actually going to be shrinking over time. And as you've spent down your assets, negative returns on a smaller pool of money are less damaging than negative returns on a very large pool of money. So for a dollar cost averaging investor, low prices for a long time at the beginning of their career is extremely beneficial. For a lump sum investor, we're indifferent. For a retiree who has to draw money down from their portfolio, we want to get all of the good returns early, and we want to reserve the poor returns for later. On that note, when we talk about portfolio construction and retirement, people misperceive the power of reinvested dividends. And this is something that we deal with even with sophisticated people, sophisticated clients who have a pretty firm grasp on how investment returns work, where they're really getting their return, that kind of thing. These are not people who are new to this. These are people who are experienced investors. They will often regard a period of volatility as positive, and they'll come to us and say, well, the results haven't been as good as we wanted, but since we've been reinvesting the dividends, it seems like I kind of stand to benefit from that volatility. And that's kind of half right. And it's half right, well, maybe not even quite half right. It's kind of right because, yes, on the portion of your capital that is going to be represented by that reinvested dividend, and for most equity investors, that's a very small number. So the S&P 500, as an example, yields something about like less than 1.5% per year. So on $1 million investment, you're talking about $15,000 worth of reinvested dividends per year. So if you looked at that over the last decade and you said, well, I probably turned out okay because I was reinvesting my dividends, it's just not quite true because you didn't have enough in dividends to really overcome the negative years that you experienced on your principal investment. Okay? So when you enter retirement, what might this mean for you? Well, what it means is if you are looking at the distribution of your assets and you maybe have some safe assets in place that you can spend down for, say, the first 10 or 15 years of retirement, that's a really good place to start. Because now at the very least, you don't have to liquidate your more volatile assets during that really crucial first 10 to 15 year period. But what that tells you is there should probably be another bunch of assets that are a little bit less likely to dramatically decline in value over that time than, say, a really aggressive investment. So for the bucket of money that you might need to spend right after the first 10-year period while you're retired, that should probably be something that is a little bit more conservative than, say, the S&P 500, maybe has a little bit more of a dividend focus where more of your total return is coming as cash flow as opposed to coming to just capital appreciation because dividends tend to be a little bit more predictable, a little bit more stable over time. And you should reserve the much more aggressive piece of your portfolio for that maybe 20 plus year investment time horizon because at that stage of the game, you're not necessarily entirely indifferent to volatility, but you have a much better shot at earning a substantial rate of return on higher volatility assets the longer that you own them, okay? And so really what the point of breaking this mathematics down for you, if you're still with us here, is don't be confused by the value of reinvested dividends, especially if they are in a part of your portfolio that you might ultimately need to turn to cash. Volatility is not really the friend of the retiree, even in their equity portfolio, especially if they're going to spend that equity portfolio down. Why? Because retirees do not have the benefit of making large purchases at low valuations. You're not harmed by them as much if you don't sell them, but you're only benefited by volatility as a retiree who is not adding to your investments if that volatility means your average annual rate of return is higher than it would be if you owned a slightly more conservative basket of securities. That doesn't mean that you should always be seeking highly volatile assets in an effort to increase your rate of return, because sometimes, as we saw with the S&P 500, it takes more than a decade to resolve those dramatic downturns. So if you have assets that you need to turn to cash as a retiree within a 15-year period, it isn't always beneficial to be seeking the highest rate of return that you can find on those assets. It might be a little bit more beneficial to seek a reasonable rate of return with a more circumscribed standard deviation, which is just a measure of volatility. However, as a young person, somebody who is a net buyer of assets over time, you should invite as much volatility as you can stomach in. Why? Because during the dramatic downturns where asset prices are severely depressed, you're going to be putting more into the market than you have exposed to the market, which means that you are actually going to benefit from owning higher standard deviation or higher beta, which is another measure of volatility, assets in your early years. As you get towards retirement, we need to think about migrating toward more stable assets, slightly less aggressive equities for a portion of your portfolio, a very conservative portion of your portfolio from which you can spend during the first 10 to 15 years. And then for your longest dated assets, you could talk about 25 plus years, maybe assets that are going to go to your children. Those are really where you want to invite volatility in as a retiree.
To all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.